Hi, guys. Thank you so much for joining me for this episode of Blockchain Banter. Thank you to all of our viewers as well. I'm Jen. I'll be your host, and I'm here with Batco from Margin.io and Mark Richardson from Bancor and Carbon DeFi. We're going to be talking about market making, and I feel like this is a really, really important one to talk about. And Mark, it's almost silly that in the 3 years that I've been doing these calls, I don't think this has been one of our discussion topics yet. So I'm really looking forward to kind of getting to the nitty gritty of all of this. I want to start with intros though. Matko, maybe I can go ahead and pass it off to you first. Tell us a little bit about yourself.
Sure, my pleasure. And thanks for having us. And as you said, for hosting this very important question and actually a very, very interesting topic to familiarize people with what I assume a lot of people think is a very black box in the shadows industry, very convoluted, very complicated. So most people don't even bother about it. So I hope that my humble 2 cents are going to add value to the discussion. Personally, Matko from Croatia, did business, Master of Science in Innovation Entrepreneurship, ended up in crypto after realizing that consulting and finance is not my cup of tea, that I need a bit more excitement and innovation. And basically been working as a business development specialist for Margin.io, which is a non-custodial market maker based in Germany, where I can get more into the details of how our service works and how it compares to other solutions in the market. But that's basically the nitty-gritty of it, where we're focused on both early stage projects, where it's a very conducive solution for projects that are hitting the market. And also we have an institutional vertical, which is basically our bread and butter, or becoming our bread and butter at this point, where there we deploy the very forefront of all technical innovation that we do in the company. We deploy for institutional players. Once we refine it there, we also hand it over to the early stage projects. So that's like a quick and dirty summary of everything.
I love it. Thank you so much. And it's so nice to have you here. Thank you. Mark, may I pass it over to you, please?
Yeah, sure. I'll keep it relatively brief. So my name is Mark Richardson. In a previous life, I was an organic synthetic chemist. So I did my PhD at the University of Melbourne, my first postdoc at UCI, where I was also a teaching professor for 2 years. Immediately prior to the pandemic, I was completing a postdoctoral fellowship for the Commonwealth Scientific and Industrial Research Organisation in Australia, which is the government branch of Australia's scientific industry. And then into the pandemic, the city I was living in went into lockdown for something like 2 years. And while trying to think of ways to be useful, I discovered blockchain and DeFi in particular. First became involved as just a community member, anonymous volunteer, and then moved into a fully contracted position for Bancor beginning in January of 2021. And I assumed leadership of the project in October of 2022.
Thank you. It's interesting that you choose the wording to make myself useful. And Bancor has created a few different products since you've taken leadership. And I think we'll kind of get into a little bit of how you see yourself as making these contributions and actually being useful to the industry, right? So interesting take on words. This, I caught the discussion that you guys had at Web3 Amsterdam, the panel discussion, and this is what really kind of started my want to host this call. It was a fantastic panel. It was a fantastic discussion that you guys had. And there were so many things that, of course, that really so many in our industry don't know about. And it's so often that I see market makers, I guess, not necessarily being spoken so highly of, right? And so it was interesting.
That's one way to phrase it.
We don't hear from you guys directly. Right. And so it makes it even that much harder to gain a real, true, genuine understanding of what market makers are and what you do. So maybe we can just start with a really simple question of, what is a market maker? What is market making?
I guess I can take us away here because I'm going to be providing the more boring, centralized perspective, where Mark will be able to enlighten us more on the DeFi and the decentralized side of things. And I will actually use an analogy that I used in Amsterdam as well at Web3, where the easiest way to understand market makers is to picture a nightclub, like a disco party, where everybody's having a good time, everybody's getting drinks, everybody's dancing. Market makers are the dance floor. They're the ones providing the area where everybody can interact, everybody can, engage seamlessly, and making sure that everybody has a place to have a good time, i.e., trade. So I guess using the analogy then to actually go like more concrete, market makers just make markets, or rather they manage liquidity that is present on exchanges, on order books, making sure that traders, whether they want to buy or sell assets, they have a counterparty there to actually trade with. So what market makers do, they bring the spreads in closer, they reduce the cost to traders, and they just add liquidity to the market, making it more transparent, making it more stable, making the price more resilient to volatility and fat finger trades. So just overall making sure that the price is fair, that the price is stable, and that there's no shenanigans going on in the background. At least in the ideal world, they would be the safety net, but then reality usually has a way of surprising us, as we saw, unfortunately, last year.
The way that you explain it is so pure, right? It's very clear, it's very pure. You can see the intent behind it, right? And understand what it is that you're actually doing. Why then do market makers have this sort of reputation? I apologize for saying that, and I hope in DeFi, maybe specifically, or just in general, why does our industry seem to be so hard on market makers? If you're the ones who are actually providing this dance floor, right?
Yeah, I would say it's absolutely justified, especially after reading the horror stories from late October, early November last year with the market manipulation as a service convictions by the SEC. So absolutely, most of the criticism is more than justified. And in terms of what is the reason and the driver behind it, it's the same as in traditional markets. The main driver for making bad decisions is greed, where it's just people want to make profit quick, and they might want to make a lot of profit quick. So they're incentivized to, explore more unconventional ways of actually making money. And then crypto is just a perfect breeding ground, or a very fertile ground for greed to propagate, because it doesn't have regulation. So where, in traditional financial markets, you obviously have a separation of powers, a separation of supervisory roles, a separation of responsibilities between market makers, exchanges, brokers, financial, supervisory bodies. In crypto, most roles are merged and centralized into a single authority, where Binance acts as its own exchange, broker, and market maker. And here we lose out on all of the supervisory activity of the traditional finance sector, where obviously it becomes more conducive to just run scams and manipulate markets in crypto, because you don't have the fail safes, you don't have the obstacles preventing, or rather the checks preventing malicious behavior from being done on markets.
Have you found, and Mark, go ahead, I see you unmuted.
Yeah, I was going to comment. It's interesting that the crypto community, right, the blockchain community, has really rallied behind, or towards, I should say, this idea of like a supervisionless system, and then has the goal to complain about, the ramifications that come with that. The stuff that Mako has pointed out is absolutely correct. The way that market makers are forced to operate conventional markets is around this idea of a fair price, right? Like that's kind of the regulatory mandate, and there's margins on this. It's not necessarily a perfectly defined term, but the prices that you're allowed to quote, and the markets that you're allowed to participate in, especially participate in simultaneously, and I underscore that point, is deliberately governed, and it's because you can wield these systems to enormous personal financial benefit. This has been demonstrated, at scale just recently by the Trump administration, by the way, where the personal friends of the president of the United States were able to post zero-day options, prior to news releases and things about tariffs and that kind of thing. And so, in conventional systems, and politics is normal, these supervisory and law keepers, if you want to call them that, are there specifically to avoid that kind of malicious, nefarious behavior. And it's that kind of supervision that I think most people came to cryptocurrency to avoid. And it's not necessarily because they wanted to do that kind of stuff, right? I don't think for a second that everyone that's attracted to cryptocurrency and blockchains is a criminal, but it is very attractive to criminals. And if you are a very sophisticated, well-funded market maker, then the fact that the things that you might want to do in your regular business dealings is considered a crime, but it's not considered a crime in cryptocurrency, might be too attractive to ignore entirely. And there's a fine line there, because I think that a lot of them, like a lot of the let's say the market makers that don't have the best reputation at the moment, I don't think that they even necessarily go all the way. They stop within an inch of completely destroying the cryptocurrency markets. You could argue that that's because they have an incentive to at least keep them afloat for a little while longer, so that they have some job security into the future. But I don't think that that's it. I think that it's that they have realized that there is a margin for profit to be made by doing things that you can't get done in conventional systems, but that even then they fall short of complete criminal activity. And then there's the market, and then there's the the market makers who completely forego that, right? People that are seemingly without a conscience, that do participate in all out no reservations criminal activity. But I think that these are the exception and not the rule. Whereas the majority of market makers still, I think, fall into that sort of questionable category if we measure them by conventional market standards. But that doesn't necessarily mean that I consider them all to be, or people that fall within that category, to be overly malicious. They're just a little bit more cavalier, I think, is the word I would like to choose, than they otherwise would be if they were, doing normal securities exchanges or something like that.
I think this is where we're seeing a lot of the ethical market making. This is something that I'm seeing more and more of now, is, not just seeing, but hearing, right? I think it was mentioned a few times in the discussion that you guys had, and I see it in posts and things, mainly from market makers. And this is really what they're saying is they are providing ethical market making. And so really, go ahead.
I think this is a good segue. I'd really like to tap macro into the conversation here as well. And that's that, like, it's important, I think, to also acknowledge the almost impossible job that market makers actually have. Because, what distinguishes market makers from anyone who's just trading via like limit orders, is that market makers, by definition, like professional market makers, are forced to take both sides of the market, right? So they don't just offer bidding prices on the thing that the market might want to sell to them, but that they then need to post asking prices as well if people want to buy that asset back from them. And that's an extremely difficult thing to do, especially with something as volatile as cryptocurrency. I previously argued that some of the stuff that we consider to be unethical, some of the practices that we see, have actually come about as a result of the volatility in cryptocurrency, right? Where the profit margins can be, or not necessarily the profit margins, but the inventory risk can be so extreme that you do kind of need to keep a very healthy cash balance for those, minus 76% days. And it is an extremely challenging position when you must, buy things when people want to sell them to you, and you must sell them when people want to buy them. And I just thought that it's an aspect to that business that I think few people recognize is not just difficult, but stressful and almost impossible an ask. And I just thought that Mako would have something to say about that.
Yeah, it's a thankless job, because when you're doing everything right, nobody notices. But as soon as you screw up along the way, then you're hitting the headlines. But yeah, as you say, it's you're basically making, as a market maker, opposed to a private trader, a private investor, a day trader trying to deploy a ping pong strategy of trading between the spread. As you say, they don't have that obligation of necessarily taking both sides of the trade and maintaining some liquidity on the order book at all times, which makes it much more difficult for a market maker, and it forces us to also invest much more in the development of our tech stack. So again, like even on the institutional side that we're seeing now that's come online with us in the past 6 months, the name of the game is eking out 1 or 2 basis points of profit per trade, which for a day trader or a crypto native degen, that's nothing when, as you say, you have single day candles that range 70+% in terms of volatility, of oscillation, where that's where you can make actual alpha, where you can out trade the market. That's where I think a lot of people also get confused about the role of market makers in the industry in general, where especially clients on the token side, they come with requests about actively trading for alpha, actively eking out profit, or that's not the point of a market maker. Yes, you will be making money along the way, but it's not going to be measured in the X's of gains. It's going to be measured in basis points, and that's the point. Like big volumes on a big trading pair with lots of organic trading activity, lots of traders active on the pair, and you're there making the spread and actually capturing the spread as your profit. That's how market making should be done. But then people add in alpha, they add in taking positions instead of staying market neutral, delta neutral. They take positions in the token because, as Mark mentioned, of how the industry is designed at the moment, where you have massive volatility, massive inventory risk, and you don't really have regulation to offset that risk. If you as a market maker act as a liquidity provider, most likely any early stage project getting ready for a primary listing is not going to pass your due diligence checks and is not going to make it into your portfolio because you're taking on too much risk. So there you turn into basically competing for the top 50 projects that are actually valid, that are actually valuable, but then you leave out 98% of the overall industry just because it doesn't meet your criteria, it doesn't meet your requirements to actually be able to take on risk on your own inventory. So that's, I guess it's a nice segue into also saying that that was one of the core reasons why retainer-based market making and non-custodial market making developed in crypto too. Since you had a lot of these smaller projects who started figuring out that, okay, the loan and options model, which market makers developed to act as liquidity providers, doesn't really work in their favor. It's not so sexy to get, hand over 15, 20% of your overall token supply to a liquidity provider who's supposed to trade on your behalf. And they started opting for, okay, we're already taking on inventory risk. We're already taking on market risk as a token project. Might as well just act as our own liquidity provider. It ends up being cheaper and safer on our behalf. So they started looking for retainer-based models, which we started offering in 2020.
Sorry, I forgot that I was muted there. Okay, so what you're saying then, because I wanted to actually a couple of different things. One is when you're talking about buying and selling and playing both sides of this, right? Mark, this makes me think of an AMM. We've spoken about this previously because
Sure.
Mark, your new product, like Bancor's newest product, right? Carbon DeFi is more of an order book style. It's not an AMM. You're not forced to take both sides of this. So when speaking about how difficult it is, I can see that on a centralized exchange where you really have to ladder this liquidity on both sides of the market. But is it simpler or go ahead? I want to kind of compare it to the decentralized infrastructure for a minute.
Sure. Okay, so let's back up and characterize some of these things correctly. So the AMM infrastructure, the AMM paradigm, is a kind of self-financing trading strategy, and that describes a lot of market making as well. The thing that distinguishes an automated market maker from an order book is that it enumerates its liquidity from a price of 0 to a price of infinity, and effectively, programs in what the slippage is, or if you like, the size determined trade pricing as a function of its token balances, in order to force the condition that it never runs out of liquidity. That's basically it. And that means that, the token reserves can get very small or very large, depending on which way the price is moving, but it will never completely run out. And in the beginning, Bancor released that technology because it was nearly impossible to get tokens onto centralized exchanges at that time, right? This is back in 2016. So things like Bitcoin and Ethereum and a handful of other things were available for Coinbase and Binance, things like that, and Mt. Gox. The burgeoning, altcoin economy required a different approach. And if you have a look at the commentary that was provided by E.L. Herzog at that time, and some of the things that was written about in the Bancor white paper, was basically acknowledging, and remember, this is at the birth of cryptocurrencies we know it today, right? So think, there were dozens of tokens, not dozens of millions of tokens. And it basically said that if you want someone like a Forex market maker to take your tokens to exchanges, you need an enormous amount of trade volume, and an enormous amount of people interested in participating in those markets, like hence the trade volume. And that's just not going to happen with small communities of cryptocurrency traders. And at the time, cryptocurrency wasn't necessarily exclusively price motivated. And so people were trading tokens for all kinds of different reasons, whereas today it's predominantly as like an investment vehicle, but back then it wasn't. And so the AMM really served that specific use case very well, where you still need price discovery or some version of price discovery, but that the markets are always going to be so small that no market maker will ever be incentivized to make markets for you. And so the AMM meets, I think, that need very, very well, and is, still currently sort of uncontested king of, micro markets in cryptocurrency. An order book is a slightly different structure because it's not necessarily programmatic. The way that prices respond to market changes in sentiment is a function of the orders that are in that book. So rather than having a continuously interpolated price range, instead what you have are unit sizes and price quotes for those units. And so when people buy up stuff from the book, that moves the price. And if we didn't have a market maker there, as units of, for example, bought, the spread would increase massively, right? You need someone to come in and then place orders immediately underneath the price as those things are taken. So an AMM just automates that process, but it doesn't necessarily replace the expertise of a market maker and an order book in general. And I've said this before. When a market becomes sophisticated enough, right? When it gets out of that adolescent stage and starts to become something that, thousands or hundreds of thousands of people are interacting with daily and starts to process millions or billions of dollars in volume daily, actually kind of, you want to use an order book because it no longer, struggles with, some of that adolescent behavior that the micro markets have, and now becomes feasible for a market maker to interact with because those volumes are much more attractive. And moreover, the people who are interacting with that market would prefer that it's managed by a market maker than an AMM. And this is one of the things that we saw, draw massive criticism towards the AMM back in 2016, back in 2017, because the slippage on an AMM is so is so high if its token reserves are relatively low. So that this is a horses for courses sort of argument. It's not necessarily that in the strictest sense of the definition, an AMM is still a subset of what an order book can do. An order book is the grandest, most elegant, most generalizable model for market structures. An AMM is a very specific subsect of that that relies on explicit, instructions to maintain itself. But an order book is much more general. And so that's kind of the transition we took with Carbon DeFi is that, okay, is there something that is even above the order book, right? Is there something that's more general than what an order book can do? And it turns out there is, and you can borrow from the theory that underpins AMMs and realize that every order book as it exists today is still described using what's called discrete calculus, right? So essentially the unit sizes and the prices are, have very hard defined boundaries, whereas the AMM pricing model is continuous calculus, which allows you to, quote prices as a function of any small amount of price change or order flow. And so with Carbon DeFi, we have the best of both worlds, right? You have arbitrary price quoting, and if you wanted to use it in a discrete sense, the same way that you would on Binance and Coinbase, you can do that. But if you would like to price your assets continuously over a range, then we can do that too. And in terms of memory footprint and computational overhead, running an order book in the continuous sense turns out to be a lot simpler in some aspects than running it in the discrete sense. So yeah, I just wanted to make that clear, right? It's not that order books and AMMs are necessarily two different things. It's just that an AMM is a specific implementation of an order book that only operates one way and is extremely inflexible. Whereas with an order book, it's always discrete, extremely flexible, and then you've got Carbon DeFi above that, which does everything an order book can do, but then also allows for continuous pricing models, which you don't get in conventional systems.
I guess I just want to highlight another point that Mark raised, and what he was saying, where it's not AMMs versus order books as like an eternal competition of who will dominate the industry and who will set the standard. It's two different solutions for two different problem areas. Where obviously, as Mark already said, if you're a new project just coming to market, you don't really have that much traction. Maybe you have a couple dozen or a couple hundred holders of your token, not really that much trading activity. It doesn't make sense for you to go to a centralized exchange that will have volume requirements, holder requirements, liquidity requirements. It will also cost you some tokens and some stables to actually get listed. It will cost you to maintain your order book through a market maker. You have all of these costs for which your business and your project is not ready at that point. So even I in my work, when I meet a project that's getting ready for a primary listing, if I see that the tokenomics do not hold up, if I see that the project is not at the stage of development where it can actually aim for a centralized exchange, I always tell them consider a decentralized listing, because an AMM model is much more conducive to your stage of development right now. You won't be dealing with the same issues, you won't have the same obstacles, and it gives you time to actually figure stuff out, build stuff up, build your projects out, get the community going, and then prepare for a centralized exchange when you already have a base of volumes, a base of traders, and when you can already expect what you're going to be dealing with. And obviously, you're going to be more attractive as a project to any potential market maker, whether it's retainer-based or loan and options-based. But you just will have a better case to present to anyone who you're talking to. So AMM's DEX is much more conducive to early-stage projects that are just now building up a community and trying to find it. And then order books, as Mark mentioned, for more sophisticated trading, for larger volumes, more traders involved, and also more institutionals involved, where we also didn't even touch on that it's not just retail and degen gamblers participating on Binance or KuCoin or OKX. Now we have institutional investors as well, who are moving sizes, who have larger orders, who deploy more sophisticated instruments. They don't want an AMM. They want to do something that's familiar to them, something where they already are fine-tuned, where they know how they're going to be operating and what they're going to be dealing with. Yeah.
When you say they don't want an AMM, are you speaking about an AMM? I mean, obviously an AMM like on chain, right? Or do you mean DeFi in general? Like they're more familiar with an order book. But like Carbon DeFi is an order book style DEX, right? Is it more just that they're more familiar with centralized exchanges and they're more comfortable with that? Or do you see them kind of venturing into DeFi a little bit?
I would say the one part definitely, or rather, there's two parts to why they're sticking to more traditional UIs and UXs, being that it's, as you say, it's simpler for them. They're already familiar with it. And I believe that there's a lot to do with compliance as well, where it's much easier to just justify it and to defend it in case anybody comes asking questions and knocking on the door to check how things are going in the business. So there's the part of familiarity and compliance. And then there's the actual part of execution as well, where they need to be presented certain incentives in order to participate in the market, where we can also see that with our institutional vertical, where now there's, at least I feel like there's a race between exchanges going on in the background of the industry, where everybody's trying to one up each other in terms of the incentives and rebates that they're offering to hedge funds or just large private investors to actually bring liquidity to the venue itself. And here you need to make a very, very good case to the hedge fund in terms of rebates, the volumes that they can be expecting, the additional retainer that you will pay them to actually bring the liquidity on board, where decentralized exchanges usually don't have that. You don't have a Uniswap institutional department that actually handles these negotiations with institutional investors. But Binance has one where they take you out to dinners, they take you out to VIP events, they
Right.
wine and
It's the
dine you.
schmoozing. They
Yeah,
schmooze you.
yeah,
Mhm.
exactly. They wine and
Right.
dine you, and then they ask you for a check to actually trade on Bitcoin and ETH and ADA and whatever.
So DeFi kind of has its own way of doing that, but I think it's a little bit more retail. It's like the yield farming and the things of that sort, right? When you're talking about institutional players, you definitely need to kind of elevate that sort of degen aspect that we see in a lot of on-chain activities, right? I want to shift
Exactly.
for a quick minute. I think it was B, if I'm not mistaken, during the discussion. We're talking about the main role of market makers and kind of the misunderstood role that you guys have in crypto. And if I'm not mistaken, and you can correct me, and of course we won't speak for her, but it was something along the lines of providing that runway for token projects, right? And I don't know if this was a role that you guys play, or if this is that sort of request, one of those that you were speaking about earlier, right? Like you have this main goal and then you kind of get these additional things on top of that. But do you see a lot of that? Because I've personally seen a shift in our industry over the last maybe year or so, where a lot of DeFi, and it's crazy to think that we never thought of these as actual businesses that need to make money to sustain ourselves, right? But now we're seeing this sort of shift.
That's a novelty.
We're seeing this now. So, like, we have these token projects, they have their token, they have their team allocations, but it is a very funny sort of fine line, and I was just writing a blog about this of, you just dumped on us and you hate your community. And, then it's kind of like, we also need to actually pay for certain things. Do you see this? Do you get this request from token projects? Do you see this as a sort of service that you offer to token projects?
I would say it's more of an indirect request where it comes up naturally during the discussion, especially because of our business model as well. Obviously, I have to think about these things because we're retainer based, so it's in our interest to keep a client around for as long as possible. And obviously, in that scenario, I want to also make sure that they consider the financial plan, that they actually projected their costs, and that they have a rough understanding of what their runway is and what will negatively or positively impact said runway. So it kind of pops up organically during the discussion once we touch on economics, once we start talking about, okay, their budgetary, or rather their budgetary limits, their expectations for the service, and obviously the part of treasury management as well, where I would say it's not a primary, or it's rather not a primary goal of the market makers to build a treasury on behalf of a client, but rather to do everything they have in their power to make sure that the treasury is not being impacted disproportionately negatively by movements in the market. So, as opposed to an AMM approach where we will, or rather the way that it's formulated, it ensures that thanks to the slippage and rising costs, you never run out of your full inventory. Or with a market maker, with a person there, we can absolutely run out of inventory if the client says that, hey, whatever happens, I need you to defend a certain price point. I want price support levels at these price levels, or I prioritize, creating buy pressure and support rather than maintaining treasury. It allows you to take those moves always in alignment with the client and always having, the expectations set.
It's interesting that we were talking earlier about playing both sides, right? But just now you were saying that clients will ask you to defend a certain price point. Is that like a stable coins, things of that sort, Is it maybe something like a sort of pegged asset where it's like, we talked about those 76% drops and things, like those aren't unheard of in our industry. You've got to have something to protect against that sort of volatility. Is that the sort of token you're speaking about?
Exactly. It's either stablecoin projects or projects that for one or another reason are linked to a broader asset, a bigger asset. It's usually Bitcoin or ETH for one or the other reason, where they just want to keep that one-on-one peg and to trace the price along. So they're obviously, if you get the request of, okay, we will align it with Bitcoin, if Bitcoin goes against you, there's not much you can do if that's your strategy and this is how you're treating the project. So there you have to, as a client, you have to be ready to take on that inventory risk. You have to be aware that, there is a possibility that if the price goes down 90%, that your inventory will go down 100%. If, these were the stipulations of our agreement and of the strategy that we agreed on.
It's interesting. It's all really interesting. I wanted to also talk about, I know we have maybe 10, 15 minutes left. An interesting point that was brought up during the previous discussion also, and I know that this is just across the board, something that's kind of making its way into all aspects of our industry, is AI. And it was really neat to hear about the different takes of AI in market making, whether it was as a competitor, right? I think it was you who was saying, it would be interesting to see how I fared up against an AI market making, or, it was like a DAO decision run AI agent that was making markets. How do you guys both see that happening, or, how do you see AI making its way into market making?
I guess I will leave this one to Mark, because I would say that AI probably has even more impact on the decentralized side where there's no people involved. But I'll happily give my apocalyptic perspective from the centralized side as well.
You and I might see eye to eye there, but go ahead.
Yeah, but in general, it's inevitable. Like, as we see with these LLMs and open AIs and all the solutions that are now being peddled to retail, where it's inevitable that AI will play some role, whether it will be just AI agents acting as market makers and not taking any money for the service they provide, whether it's just going to be additional tooling and instruments that will allow a person to make critical decisions and to improve their edge and to give them a competitive edge. If I had to place my money on one or the other, I would say that the latter scenario is more likely. So inevitably, we will see more and more AI getting implemented in the algos themselves to make the decision making for the people behind the algos easier. So instead of having to do the technical analysis yourself by hand, instead of having to dive into on-chain liquidity analysis, you already have these fantastic AI solutions that can measure market sentiment, do qualitative research in terms of, social media trending engagement, give you that like soft side of things to take into account on your unwinding of positions or preparation of positions. It can give you recommendations, extrapolate just bigger sets of data and extrapolate more tangible conclusions from those. So is it gonna, add, or rather push the industry to that next level and next step? Absolutely, it will. Will we see fully automated AI agents acting as standalone market makers with no human input? I hope not, because there we're going into that apocalyptic end of the world doomsday scenario where I wouldn't feel comfortable. I wouldn't feel comfortable with that solution, primarily because of compliance reasons and because of what we touched on, ethical market making reasons. So if you give an AI a job of, look, make markets, maintain a spread, but then also make sure that you're capturing profit along the way, I can see many ways how an AI can misinterpret that input and actually start causing harm, because it will try to maximize the profit one way or another. A human most likely wouldn't go the same direction, or won't be as likely to fall down that slippery slope as an AI would, unless
You can
he's
actually
driven by
put that,
greed.
yeah, you can put that actual thought into the process and create that sort of balance versus take that, you do this and okay, great. It is a thought. And, in crypto, we always say like code is law, right? Well,
Yeah.
what happens when an AI agent comes into play and something does go wrong? What happens then? Like it's an interesting sort of exercise. Mark, I see you sharing some things here. I'm going to put the comments.
Yeah. So I
In
put
here.
up a Wikipedia article to something called the 2010 flash crash, which occurred on May 6, 2010. It's something I've tried to bring attention to before, because we pretend like AI is a new technology, and it's not, right? It's at least 35 years old, depending on how you classify it and who you're speaking to. But it's a very old technology, and like everything in technology, things get very quickly adopted by finance. And the rubber really hit the road with what we now call high frequency trading, which is very much a sort of AI dominated financial sport, and has been since its inception, right? By its very nature is something that you cannot let humans do, right? Because it requires microsecond level, if not slightly faster than that, decision-making abilities. And so we've entrusted computers with that task for, since the, late 80s, early 90s. And yeah, it hasn't always gone very well. And, specifically with HTF stuff, we're talking mostly about taking markets, not making them. But I would also argue that at the level of resolution that they're operating at, sometimes we're splitting hairs when it comes to sort of definitions between taking and making. And yeah, like the 2010 flash crash on the Dow Jones was caused by AI. And there was one about a year later, almost a year to the date, in I think May 7th or May 8th, 2011. And so it's not new, right? Like I said, splitting hairs a little bit with respect to taking and making, but I do not doubt that there are systems already in markets all over the place that people have offloaded some of the decision-making capacity to computers, and have done so for at least the last 2 decades. So to say that AI is coming or something like that ship has sailed, before I was even born. It's been here and been dominating finance, for my entire life. With respect to like new AI, or what people are referring to AI now as, is a little bit more black boxy. The thing that I would say distinguishes, the most recent generation of machine learning algorithms from the last generation of machine learning algorithms is that it's becoming increasingly difficult to articulate exactly what it is that it does, right? How it operates and that kind of thing. By its very definition, it takes enormous amounts of data and trains itself on patterns that humans cannot interrogate. But having said that, it still distills things down into a type of, statistical model with certain parameters and things. It's just that humans don't really understand what those parameters are because there are far too many of them. And in that sense, it's a lot less predictable. When the flash crashes and things that were occurring in 2010, we at least had the ability to open up that software and see, what the cause was. What was it about those trading algorithms that resulted in a stock market crash? Whereas today, there's nothing to do except ask the algorithm in plain English why it did what it did. And it has no, knowledge of or concept of truth, right? It will just tell you whatever it is that it thinks that it should tell you based on its training data set. And that's a little bit more frightening. To anyone who has used AI with some regularity, I think will be familiar with concepts like hallucinations, right? Where despite being given a very specific prompt, or very explicit instructions on how a task should be completed, the AI will sometimes ignore what you've asked and do something else entirely. And it can sometimes be very difficult to get it back on course, often requiring, resetting its memory or something like that. And the reason it does that is because of how these things are designed, right? It's a feature, not a bug. And I think that a lot of people in finance in particular are looking at this like, they're getting FOMO the way that people usually do, thinking that their businesses are going to be left behind if they're not fast enough adopting this technology and so on and so forth. I think that that's a mistake. In general, if you can't articulate what it is that you're doing, or if you have no understanding of what it is that you're doing, you become a mark for other people to take advantage of. And if there are large financial institutions who are implementing software that they do not control, and let's be clear, right? If you're implementing an AI, by definition, you don't control it. Something bad is going to happen. And I know people that have already started doing this, begun to make a profession out of exploiting other people's trading software that's implementing large language models. I think that what we will see in the next epoch, right, is first that there'll be a learning curve. There'll be, some bankruptcies and, other market instances like the flash crash in 2010, which, by the way, resulted in an immediate step in from the SEC to regulate HTF trading. I think that we'll see something like that. Although, in the lawlessness that we're currently seeing in the United States, I'm not sure what to expect. But either way, I think the industry will self-regulate because these mistakes can't happen, too often before people decide to do something about it. In that next epoch, I think we'll find something like a hybrid technology, and this is one of the things that DeepSeek might have actually already accomplished. We're not really sure. Where it seems pretty clear that DeepSeek has at least partially been trained on some of the data and models that OpenAI has released. But what they did was to effectively condense or better describe some of the parameters that their models use, as a part of their large language model. And that means that they are, they're better defined. I think that we'll see something like this, where people use a large, poorly defined, fuzzy AI model and let it come up with sort of its parameters or whatever, maybe train it on 200 years of trading data or something like that. And then at the end, whatever that model is, you kind of start distilling out what those parameters are and then define a proper, what I would call a multivariate analysis model, or, slightly more colloquially a machine learning model, but something that has very specific dials and things that humans can actually interrogate. And I think that that's in that sense, the AI models that we know today will become more like collaborators in the design sense, where they are, using something akin to stable diffusion to arrive at a parameter set that best describes what the company that's employing it is trying to achieve. And then they employ a very strict model at the end of it that won't be able to hallucinate and things like that. But where that's certainly not part of the course today. Like I said, I suspect companies like DeepSeek are already doing that or have already done that. But if anyone thinks that Cursor or ChatGPT or Gemini or something is going to operate a financial market for them, they really have another thing coming.
I forgot I was muted again. I think we're seeing a little bit of it where people do think that. So it's a little bit of a scary thought. We do have about 5 minutes left. Now, I know, we don't shill, we don't, like shameless plug, but we've got 5 minutes. So we're going to do it today. Matko, we didn't really talk about it. Like, you were saying that if you've got token projects that are looking for market making services, you'll look at them and maybe you're not quite ready for this. I suggest you do this, whether it's token projects or whoever it happens to be, like, what would be your message, especially knowing that market making is misunderstood, right? How might they want to look at this differently? Why would they want to seek your services? Go ahead and give it to us. And Mark, I'm going to pass it over to you after.
Yeah, quite a tricky question to ask in the last 5 minutes. I'll try to keep it, to summarize it and not to go into too broad philosophy. Although I have to be a bit philosophical here, just at the beginning of my answer. One general, just overall advice for anyone building in crypto right now and anyone building a crypto project is focus on the business model, focus on the product, and don't think about listings, don't think about liquidity, don't think about market makers. Where I see, especially today, I was hoping that things would change since the ICO craze in 2016, 2017, but they haven't. Where 95% of the token projects that I talk to are solutions looking for a problem, or rather they're cool tinkering and cool new stuff coming out, but that doesn't really have a market, doesn't generate revenue, doesn't have a go-to-market plan, doesn't have anything that the regular business would have. And they're talking and thinking about, we want to list on XYZ exchange, whatever, where it doesn't make sense. Build up a business, build up utility behind the token, build up anything, and then let's talk about listing. In terms of then once we've actually built a product and a business and we've come to the point of where we can talk about market making, my key advice would be to take it slowly and really think about everything that's being said to you. It's very easy to fall into this trap where I've heard horror stories about market makers promising outsized returns, incredible profits, just money printing every single day. We're just gonna go to the moon straight away. It's very easy to fall in love with all these false promises, but market making is anything but. It's boring. It's not flashy, or rather it shouldn't be flashy. It's basically a part of the key infrastructure that you need to consider in order for your token to be successful one day. So I guess the advice, in plain English would be go with the boring option, go with the Honda Civic, the reliable one, instead of the flashy Ferrari that's probably going to let you on the road after a couple of kilometers. Where, of course, the Ferrari is more fun and flashy and more exciting at first, but the Civic is actually going to get you to where you need to be, even though it's going to look more boring and be less exciting. So, take your time, build the business up, try to understand what liquidity is, and find somebody that's actually willing to sit down with you, guide you through the process, actually educate you on the key things, the key principles. And I guess also to shill ourselves a bit, someone who will, in key moments, tell you that, hey, this is not for you right now. Consider this option where we're knocking business out of our hands, but at least we know that you'll be safe, that you won't crash, that nobody will make use of you, and that one day maybe we'll have another chance to work together once you've actually built up a solid foundation and a solid base.
That's awesome. And I feel like the first half of this, come up with a business model and this, like, it's just great advice across the board, not even talking about market making, I think just in general, right?
Just life advice.
Life advice, right? Mark, do you have a few minutes? Because we'd love to hear from you as well. And whether it's Carbon DeFi and, you know, what you guys are building, or token projects, market makers, you know, go ahead and give us yours.
Yeah, sure. So yeah, I think that examining Bancor's narrative, it identified like very key issues, in the genesis of cryptocurrency and blockchains when it came to like micro markets and that kind of thing. And you can kind of see it now sort of transitioning towards the professional players as well. So whereas the AMM paradigm was appropriate, in its own context, and like I said, I think it remains appropriate, and I think it seems that Mako agrees with me. For small bespoke projects, or at least projects that are still in their infancy or adolescence, I think that that's a really terrific tool. But our focus now is on developing from the other side, and maybe have products that somewhat meet in the middle. And so Carbon DeFi is obviously I think it appeals to the retail trader as well, because it appeals to people who have a specific trading strategy in mind, or who are used to posting limit orders because they know about the risks of trading spot, for example. And I think that that's an easily serviced demographic. But the much more difficult demographic to service is people like Mako, right? The professional market makers that are used to dealing with the kinds of with the kind of flexibility that they have on conventional exchanges and the infrastructure that they represent. And that's what we're trying to do. And Carbon DeFi is the first step towards that kind of flexibility. And we will continue pursuing that goal, and there will be future developments. It's not like Carbon DeFi is the be all and end all of the Bancor project. We're always working on new things.
Awesome. Thank you, guys. Mako, best way to reach out to you if somebody wanted to get in touch, would that be on LinkedIn?
LinkedIn and Telegram. I'm fastest to respond there. I can share both in the private chat now.
Perfect.
So there's the Telegram, and let me just pull up the link for my LinkedIn as well. Also happy to connect with anyone as well. As I mentioned at the beginning of the call, I also do lectures for university students in entrepreneurship. So if anybody wants to pick my brain on anything business related, product related, just chat about cool stuff, innovation, tech, startups, crypto, the inevitable fall of Western society, feel free to reach out. Feel free to reach out, and I'll talk your ear off.
I feel like you and Mark would just get along so well.
Oh, we get along so well. Yeah, just even in Amsterdam.
Talk about all of the above. I mean, my goodness, it's great. I shared okay, perfect. I shared your Telegram in there. I'll go ahead and share this as well. And I'll go ahead and share mine. I mean, my Twitter handle is up here on the screen. So anybody has any questions about Carbon DeFi and Bancor, go ahead and reach out to me and I will filter you through appropriately. Let's see, I didn't get your LinkedIn. I'll go ahead and share the LinkedIn after. It looks like it might have an issue. Thank you guys so much. I know we went a few minutes over. I do appreciate you being so patient with me and sticking around. It's been a pleasure. Thank you for helping me kind of get rid of maybe some of this misunderstanding that we've been seeing, and maybe clearing the air a little bit, clearing it up. So thank you. I appreciate you both, and thank you to all of our viewers as well.
Sure. Thanks for having us. It was an absolute
Of course.
pleasure.
Thank you so much. Okay.
Mark,
bye, guys.
See you around. Jen, likewise. Talk soon.
Talk soon for sure.